Hello, everyone, and welcome to 32Soft's June webinar. I'm Denise, your host, and with me to present is QAD and MRP expert, Don Lindsey. Once again, we do have much to cover, so let's jump right into housekeeping. And at long last, I will hand off to Don Lindsey, who is a business analyst for several companies and has 18 years of QAD ERP experience. And throughout those years, Don has worked with 7 different versions of QAD. We are delighted to have Don with us to share his depth and breadth of knowledge. So, Don, whenever you are ready, I will hand off.
Okay, if you want to go ahead and click the magic button.
And there's the magic button.
There you go. And can you see
Yep.
the screen? Good.
Looks
good.
good.
Morning.
Great.
And thank you, Denise, for that glowing introduction. Very undeserved, but thank you anyway. So welcome to our June webinar. In May's webinar, Show Me the Money, and the short YouTube video, Origins of Accounting, we started the discussion as it revolves around accounting, one of my favorite subjects. This webinar is much the same as it covers another aspect of accounting. Since Origins of Accounting covered a little bit of the history of accounting, where double entry bookkeeping came from, and the last webinar we talked about the ways in which the supply chain impacts the general ledger and accounting. Today I'd like to talk about the concept of plan versus actual, or in accounting terms, variance analysis or variance reporting. Today I'd like to talk about first understanding what variances are in accounting. We're going to talk a little bit about purchasing variances, accounts payable variances, manufacturing work order variances, material, labor, and burden, rate, and usage variances. We'll mention subcontract variances, mixed variance transfer, and then one of the most favorite variances, method variances. And then we'll finally discuss some reporting in QAD for that. As I always say at the beginning of our webinars, there are many terms and definitions that one needs to become familiar with when dealing with the accounting functions in QAD. We have covered such concepts as cost sets, cost methods, cost elements. But today we want to talk about some terms that deal with variance, such as PPV, rate, usage, method. If you do not know the meaning of a term or a phrase that we use, please use Google to look it up, or to go to the knowledge base on the QAD website, or send Denise or I an email, and we'll be glad to assist in a definition. Remember that everybody uses terms that basically describe the same thing, but in your particular environment, it's important to understand how you calculate these kinds of variances and values. So I always suggest that, number one, you have a real good, solid set of work instructions, and that you have a company data dictionary, a wiki, if you will. I was looking around on the internet and I found a great presentation on wikis in QAD in the spring sessions for MUG from 2018. A gentleman named Bill Linder from Right Way Fasteners has a presentation out there. I love my QAD wiki. And if anybody has access to the MUG past presentations, I'd highly recommend that. So, as today's topic is variance, we should define variance. So what is variance? Well, mathematically, variance is the value of X of an expected value of the squared deviations from the means, or written in mathematical terms, var of X equals E of X minus U squared. So I always recommend that Wiki is a good place to look up things. So if you don't know what that variance really means, go go to Wiki and type in the word variance, and it'll explain what that is. We're not going to get too much into the math, but we want to talk more today about MRP and ERP, not MRP, but ERP, and exactly what that means. It's the difference between a budgeted or planned or standard and the actual amount occurred. So that's what variance really is. And variance can be computed for both costs and for revenues. The concept of variance is intrinsically connected to the planned and the actual results and the effects that those differences have, or the differences between those two have on the performance of your company. Again, it is most basic. Variance is actual cost minus standard cost. You can have positive variances, in that case which actual is lower than standard, or you can have negative variances in which actual is higher than the standard. For example, positive variances might be caused by high standard costs. Negative variances might be that there's extra cost of production in your product. And there are various and an abundance of other reasons for variances, which we'll talk about in the webinar today. Our goal today is to understand the differences of this plan versus actual and endeavor to use that understanding to minimize those variances and thus make our plan as close as possible to actual. There's all sorts of variances. We're going to talk about primarily accounting variances, but you could have exchange rate variances. You can have tax variances. I'm sure all of us love those, difference between planned and actual tax rate. We've talked in the past in our forecast and MRP webinars about the difference between planned sales and actual sales. That's another type of variance that we use to calculate safety stock and mean absolute deviation. So there's lots of others, but today we're going to concentrate on cost and operational costing. If we look at operational and cost flow, probably the first thing we do is to buy something. So let's look at the first type of variance called purchasing variance. Purchasing variance or purchasing cycle starts with basically determining the need for the item, either through MRP, your reorder point, or however you do that. And then you cut a purchase order. And the purchase order is 5.7, and this is triggered through an MRP order action, and you enter both the header information and the line information. So you cut the work order, then the supplier gets the order, they manufacture the parts, they send them to you, and you do a purchase order receipt. So when the order that you placed comes back into your organization, you do a 513-1, and that then receives the item into quantity on hand, crediting accounts payable, debiting inventory. And it is this point in the process that you can incur what is called PPV. So then you inspect the part, you put the part into inventory, and the supplier sends you an invoice, which we'll talk about in just a second in terms of the accounts payable possible variances. So purchase price variance, referred to as PPV, is equal to the PO unit cost minus the GL or the standard cost times the quantity received. And this occurs at the point of PO receipt. So this is a rate variance. Purchase order receipt or purchase order cost and standard cost. You can review this through 5914. This is the receipt transaction report. And you see over here at the right, you've got the PO standard variance, which can be viewed through this screen. You can also look at 3.21.1 transaction detail for each transaction number. This little inquiry gives you the accounts that are debited and credited in the GL. You can see we've got raw materials, unvouchered receipts, and here's your purchase price variance. So any purchase price variance from this transaction would then hit that general ledger. You can also look at 3.16 or 321.16. This is the transaction accounting report, and this gives you information about the GL reference. There's the reference ID, debit and credit accounts, both sub-accounts and cost centers, and amount. So this also is a very handy report to look at. So if you have a persistent PPV, purchase price variance, this means that there could be some issues either with the pricing on the purchase order or the cost that you got in the system for standard. I very fondly remember a friend of mine in one of my many supply chain organizations who was our buyer, and he always used to brag about the great positive PPV that he obtained. His actual was always lower than the standard because during the standard cost bill process, which we talked about last month, he would kind of fudge on the high side of the standard so that he could always come in with a positive PPV and look like a hero. Caution. We'll cover at the end that, and as we said at the beginning, one of our goals is to make plan more close to actual. So even though he was a hero in his own sense, probably not so much from the organization point of view. When the supplier has submitted his invoice or his documents that ask him to get paid, that's when we start into the accounts payable cycle. And we covered this a little bit in the last webinar. You place the purchase order, you got the PO receipt, then you can enter that invoice into 28.1. You go through selection processes, eventually printing all the checks, and the ultimate goal is to get the supplier his money as quickly as possible. In the accounts payable variances, these are what occurs during the vouchering of the supplier invoices. You've got a rate variance, which is the invoice price minus the purchase price times the quantity received, or a usage variance, which is the invoice quantity minus the PO receipt and the invoice. And you can review these either through 28.7.1, and here we have information such as the voucher, standard cost, invoice, quantity, extended. So you've got that. You can also look at it in terms of purchase price, and there you can look at standard, invoice, cost, extended again. That will give you a view of what those are. We've already talked about the 3.21. Great little inquiry, gives you lots of information. And then you've also got the 28.2.5, the received matching report, and this gives you a good view of the difference between the purchase order placed, the receipt quantity, and the supplier invoice. So again, persistent variances suggest that you might have problems in receiving or with suppliers. The accounts payable variances should basically be few and far between. Buyers should set the standards as close as they can, work closely with the suppliers to get the quantities and the price on the purchase orders correct, and you should have a minimal amount of accounts payable variances. You can see the accounts payable variances we talked about in the past, the 1.2.1, the production line maintenance or product line maintenance, and you can see here we've got accounts payable usage and accounts payable rate variances. And if you look at the 2515.2.4, the general ledger view, you can see that you can match those values to what is in the general ledger. Since most of the work of operations occurs in the process of manufacturing the part, producing it to sell, a huge part of variance analysis falls in the area of work order variances. So there's basically two kinds of work orders. I'll talk a little bit more about that in just a second. But you've got advanced repetitive. Advanced repetitive is for those kinds of products that I would say are very stable, little variation in BOMs or routing, can be produced consistently and repetitiously. QAD uses this repetitive or cumulative order, 18.1, to cut a manufacturing work order. So it's usually high volume, low variability. It is for a part number and as opposed to a discrete work order, which is part number, quantity, date. Advanced repetitive part number, time period for a variable quantity. In other words, how much you produce during that time period. Labor is typically reported at standard, either through direct input or backflush. Material is typically backflushed at standard, but it can be discretely issued if you choose to do that. Every time you cut a cumulative order, it rolls the cost for that cumulative order, and advanced repetitive allows you to transfer WIP from one cumulative order to a next cumulative order. The most probable mode of operation is what is referred to as the discrete work order. This is usually low volume, high variability, change as you wish. And again, we mentioned that it is open for a part number on a date for a quantity, as opposed to a part number for a period with a variable quantity in advanced repetitive. So labor can be recorded at actual, either the duration of labor or elapsed time, and we'll look at the 1620.1 transactions in just a second. There's material can be issued discretely or backflushed, and costs are copied from the cost set to the work order, and you can't easily transfer. You could if you wanted to. This takes a whole lot of transactions. There is just to mention that in 2016 and beyond, all manufacturing orders in QAD are going to be what are termed production orders. QAD has basically combined the functionality of discrete work orders, cumulative, flow schedules, and Kanban into one thing called a production order. And I've been in conversation with Guido and Brent at QAD, and they say that all the current capabilities are still there for all the discrete cumulative. They've simplified functionality, enhanced capabilities, and the production order is the foundation of the future for QAD. There are a couple of new menus. There's a post-production order variance transaction, and there's a new production order accounting close transaction. So be on the lookout for the new production orders. I don't think a whole lot of us are on 2016, but they're there. Manufacturing work orders, QAD makes a copy of the BOM and the routing at the time of the release and attaches the work order. Then standard BOMs and routings can be replaced with alternates at the time of work order creation, and then work orders can be updated to reflect the specific needs of an order, either through the discrete work order or through the cumulative order. The work order process, you first of all go through the work order, and this is a authorization to produce product. And we talked about this in terms of what it does to MRP. And this is basically the record that contains all the work order information in WO master, WO deet, and WR route. And this has all of the parts, the quantities, the BOMs, the accounts, quantity issue, rejected, all the information involved in the production of a particular product. Then the next step is 1613.1, and there you can modify the components to the work order, and this is going to determine what your material and material rate and usage variance might be. You can increase the values, the quantities, or allocations, and this then again affects the MRP. You can then do 16-13-13, and 16-13-13 is where you can modify the work order routing. So this is the calculation that begins from the 14.13.1, but you can modify it in 16.13.1. You then go and issue components to the work order, and this is where you issue parts to either allocated or released work orders. It shows in the transaction history as 3.21.1, and then you do labor feedback. I'll talk about labor feedback a little bit later. Then you can do 1611, and 1611 is what registers the receipt of the end item off the work order into inventory. And this shows as the RCT-WO in 3.21.1, the transaction by item browse. And this moves scheduled receipts to on hand. It increases inventory and decreases WIP. If anybody's interested, 32Soft does have a work order close data loader. Olena gave a webinar, I believe, back in November on how that might work, and that is an excellent tool for doing work order receipts. And then finally, there is the work order accounting close, and work order accounting close does a whole bunch of stuff, and I looked at the documentation for the new production order, and the new production order does exactly the same things. So you should execute this program regularly at the end of each fiscal period defined by your calendar, and that will take the variances out of the work order and put them into the general ledger. And we'll look at that in just a second. So QAD basically uses the same variance calculations for discrete work orders and repetitive. You can review this in 16.3.4, and we're going to cover that in a separate video that we'll talk about later. You can also look at 17.10 or 16.20.13.10, which is the operations accounting report, or you could look at the repetitive operations accounting report for more information. The key to these manufacturing variances is that the planners, the shop floor supervisors, the operators themselves, cost accountants, cost analysts, whoever you've got, they must understand the key differences in processes to understand the variances, because the calculations of variances are almost totally dependent on how you process the transactions through QAD. Material rate variance occurs during material consumption in the 16.10 or 16.12, which is the discrete work order backflush, or an advanced repetitive 1822.13 backflush. And this is the difference between the standard cost of the component at the time of the issue and the frozen standard cost of the component multiplied by the actual, or the quantity issued. So here you can see the actual formula for that. Material usage occurs when the order is closed. And that's the actual quantity issued times the quantity per times the quantity complete plus the quantity rejected times the GL cost. In the work order, it's 16.21, which we talked about. In advanced repetitive, you can use the 18.22.9 post-accumulated variances, and that will give you this nice little report. It's hard to read, but it basically gives you a report of all the GL transactions that are created by the type of variance. Then if you are using a cumulative work order in advanced repetitive, you can use 18.22.10, the cumulative order, and that then closes the cumulative order that meets selection criteria, generates the GL trends, and transfers work in process if set, like we talked. So the material variances, again, you can see the material usage and rate variances, and if you go into your 25-15-4 general ledger view, you can then trace what the value of those accounts are in terms of your general ledger. Advanced repetitive provides more flexibility, I think, than does discrete, especially through the work order close process, and it helps ensures that costs are recognized within accounting periods, because you're going to be closing those cumulative orders probably in conjunction with your accounting sessions. Material usage variances can be an indicator of poor quality or process and transactional problems. So accounting cost analysts, planners, production supervisors all want to pay a lot of attention to that material usage variance. However, sometimes it's hard to detect if you're back flushing at standard. I don't know how many of you know of Paul Rubin, but Paul is a QAD consultant that works with SIG, and he's probably one of the smartest guys I've ever met. He's triple certified distribution, manufacturing, finance, and he always used to tell me that everybody ought to just get rid of discrete work orders and everybody should use advanced repetitive work orders. And so now with the new production orders in 2016, you can basically do that. Labor transactions. Labor transactions are used to apply the value of direct labor personnel to the cost of product produced. So here you've got a little flow chart. You cut the work order. You do your 16-13-13 work order routing maintenance if you want. And then you can execute the 16-20.1. And 16-20.1 basically has two main sections. You got the header section and this down here, which allows you to record time and quality information. There's where you can do the elapsed time or start and stop time, depending on how your organization wants to handle it. And then you've got the operation complete, move to next, and previous operations checkbox that is going to tell you how to deal with the issues and variances at a particular operation on a work order. Then, if you want to, you can record rejects and rework in the 16-20.1, and this allows you a little pop-up window that you record multiple occurrences of reject or rework quantities, each with a difference reason code if you want. Then finally, you go through and do your work order accounting close, and that's the labor transactions. The labor rate variances are typically associated with work orders, as advanced repetitive are normally associated with product lines. Work orders tend to be more labor intensive, and the labor rate variance is calculated by taking your setup rate minus your standard setup rate, your actual hours, plus the difference between your actual run and your standard times your actual run hours. So if you're reporting labor, we would recommend an automated process, because if you've got a whole bunch of people on the production floor trying to go into 16-20.1 and navigate that somewhat complex set of screen frames, it can get a little bit discombobulated. So if you're going to report labor, automate it through Barcode, use Eagle, Automated Solution, Freedom, Radley. There's lots of solutions out there. So labor rate variance is calculated only if you're recording actual labor, and it's calculated by operation. You can calculate it when it occurs, at 1620.1, 2, or 3, or if you're in SE, you can use 17.1, 2, or 3, or you can defer the labor rate variance to the point of the receipt transaction in 1611 or 1612 and in accounts receivable. If you want to use actual pay rates, you can use 141321 actual pay rate. This gives you the ability to actually set the rate of pay by employee. I've done this before. It's a security ugly. Means you have to change if you've got turnover and people are there's security, so people can't look at labor rates. So you can if you want to, but I find most people don't use that 14.13.21. Labor usage occurs only if actual labor is reported and is done by operation. This again is setup hours minus standard setup hours times the rate times run minus standard run times the rate. And this is calculated when it occurs again in the 1620.1, 2, or 3, or 17.1, 2, or 3, or it can be deferred as we saw with the labor rate. So there's the accounting operations report, which is kind of a neat little report. You can relate the general ledger date to the specific account that it is going to hit, again defined in the work order section of the 1.2.1 production or product line maintenance. Then there's burden rate and burden usage. I'm not even going through the calculations, but if you want to examine in detail, you can see how they would apply to individual operations. Burden rate is calculated only if actual labor is reported, and again, operation by operation. And it is calculated again at the 1620 labor feedback, or it can be deferred to the end of the work order in terms of 1611 or 1612. That brings us finally to what we refer to as method variance. And this is one of the most misunderstood and hardest of the work order variances to come to grips with in terms of QAD cost accounting and operations. It is defined as basically the remaining WIP after all other variances have been recognized. So in order for a planner or a cost analyst to understand how method variance is generated, they have to understand all of the previous variances. The accounts payable, the material rate and usage, labor rate and usage, burden rate and usage. So after you understand how all those are calculated and how all those are processed in QA, then you can start to deal with this question of method variance. Can be caused by all sorts of issues. Routing changes, alternate bombs, alternate routings, work orders closed incorrectly, many things. It's very specific to your particular environment. There's no easy path for analysis. Some causes might be evident, some causes not. And you must have an experienced planner and cost analyst who understand your product structure and routing. And it's very dependent upon operational transaction processes. So how you transact, you just can't allow variance or undisciplined processes in the work order unless you're going to deal with a whole bunch of method variances. Method variance should not be tolerated. It is indicative of a process out of control. It should be corrected and lead to the rectification of that issue as soon as possible. Method variances are very, very problematic. There's also subcontract variances. And subcontract, again, you determine the MRP value, you cut a work order, you modify the work order if required, cut a purchase order for the line value equal S, and we'll look at that. Ship the parts to the supplier. Supplier adds value. The parts are shipped back to the organization. You do a 513.1 purchase order receipt and then a 1611 work order receipt. So the standard cost of the item is determined by the operation, where you put in both the standard cost and the supplier. Then in the purchase order line level, you determine the quantity and the price of the line, and you pick the subcontract type. This brings up another little pop-up. It allows you to put in the work order, the operation, etc. for that subcontract process. So subcontract variances occur at purchase order receipt, and you can have both a rate variance or a usage variance for that. And it's been my experience that subcontract rate usage variances require great discipline between planners, warehouse, buyers, suppliers, shipping, receiving, accounting to make sure you don't have subcontract variances. A gentleman that I talked about who kind of fudged on his standard cost, this was one of his most unfavorite areas of QAD was subcontracting variance. You've also got mixed variance. You can use mixed variance. This is calculated for discrete work orders when you are using co and byproducts. I recognize a very small number of QAD companies use that, but it will calculate that. There also is a transfer variance, which is recognized when inventory moves from one site to another, and can be done through 3.4.1, 3.4.2, or distribution orders. Standard account, let's take a look at just a couple of flow diagrams of how these standard rate and usage variances might work. Here we're given a PO cost of 9 and a PO quantity of 11. There's a standard cost of 10 and a BOM quantity of 10 and an actual BOM quantity of 11. So if we look at the difference between the purchase order cost incurred and the manufacturing cost incurred against the standard, you can see that we've got an actual PO cost of 9 and a PO quantity of 11. For manufacturing costs, we've got a standard cost of 10 with an actual quantity of 11, and standard cost is 10 and 10. So if you calculate the rate variance versus the usage variance, we've got a favorable rate variance and an unfavorable usage variance. So you can calculate that out, and that is going to give you the total material variance as favorable 11, unfavorable 10. So you've got a $1 favorable variance in this scenario. If you look at the purchasing or the supplier account, here we got a PO cost of 12, standard cost of 10, and a supplier invoice of 13. And here we enter the purchase order, one case at $12. We received the purchase order for part A at one case at $10. GO cost is going to debit inventory and credit PO receipts. And then you're going to have $2 of PPV and a credit of $2 to the PO receipts. Then you're going to get a voucher from the supplier that's going to debit the PO receipts for 12. It's going to put $1 of rate variance, and it's going to credit accounts payable for 13. Then if we look at the work order account flow, here we've got part A 10, assembly 15, and a sell price of 20. And here you can see part A is used in manufacturing work order as a component, one per case. So we debit WIP, credit inventory. Then we complete the assembly. That debits inventory at 15, credits work in process at 15. Then the assembly is shipped directly to the customer at $25. That's going to debit cost of goods sold for 15 and credit inventory for 15. And the invoice is then going to debit accounts receivable and credit sales at 25. So you kind of get a feel for how the transactions of these particular flows of purchase, work order, and sales are going to debit and credit the various accounts and their respective variance values. So a couple of general statements about work orders. Standard costs and cost elements are the basic information used to calculate variances. Item master and cost data 1.1 or 1.4.1, 1.4.9, 1.4.18. Product structure 13.5. Routings 14.13.1. That contains your material and your rate. Then we create work orders to add material and labor. And from these, we calculate material, cost, rate, and usage, labor, burden, subcontract, and then finally method, as we talked about. This process of analyzing cost variances you can potentially be dealing with a significant amount of data. It requires process discipline, managing orders, the shop paperwork, managing the order processing in terms of material issues, labor movements, any cost changes that occur, defining the sequence of events, routing definitions, and the run times or the actual events that take place within the process make that very sensitive to making sure they're done at the appropriate time and the appropriate sequence. So variances can be a great challenge, but there's lots of help. There are many reports available in QAD, work order reports menu, advanced repetitive work order reports menu, shop floor control reports menu that can assist in the examination and analysis of your variances. Since these are so valuable and important, and we're running short on time, we're going to cover these in a separate short video to help you understand how to use and approach these types of variances. We put together a little MP4 video that Denise will include in the encore, titled Using QAD Cost Reports for a Better Understanding of Variances. So hopefully, as we look forward to that little auxiliary webinar, again titled Using Cost Reports for Better Understanding of Variances, that Denise will publish. Today we've covered the definition of variance. We've talked about purchase variances, accounts payable variances, work order, subcontract, mix and transfer, variance reporting, and then we'll look forward to work order and shop floor control reporting that can help you understand and get a handle on these actual values.
Okay, again, keep the questions coming. We're happy to have them, and we'll include the answers with the replay, anything that we receive. We'll go ahead and move along to be conscientious of everyone's time. And upcoming webinars, Don will be back again in July for QAD Access, Concerns and Considerations. And then in August, Don will share his knowledge and insights about the implications of QAD roles and responsibilities. Registration is open, and as always, you can find links to any of our upcoming events at the bottom of all of our communications, as well as on our website. Alex, Don, Olena, before we close out, is there anything else we wanted to squeeze in?
No, just thank you for your attendance, and if you've got any questions, or again, as Denise says, if you've got any suggestions for subjects that you might like us to cover, please let us know. Thank you again for your attendance.
Yes, thank you. We do have a great mix of folks with us today, but because of those pesky variances, today we honor those in accounting with a definition. someone who solves a problem you didn't know you had in a way you don't understand. But hopefully, after today, there is much better understanding. I will, as Don said, include some extra stuff for you this month in email or the Encore email, some links to additional information that Don referenced during the session. But thank you all so much for joining us today, and hopefully we will see you right back here again next month.